to start. My name is Rosemary Worskin. I'm the coordinator of Studies in Political Economy, the interdisciplinary journal that's committed to publishing work that explores how politics, economics, cultural struggles interact and intersect, in a sense to shed light on how people work and how they live their lives and how they resist the kind of exploitation and oppression that's happening in their lives. This is the 40th anniversary of Studies in Political Economy this year. It started at Carleton University 40 years ago, and I believe we do have one person in the audience who was at the start, which was Leo, right?
It was 30 years.
It's 30 years ago. Oh, well, I thought 30 years ago.
Well, Donald as well.
Yeah. Oh, and Donald as well.
No, I was not. I was away.
And Pat Armstrong, who's also here and came on a couple of years later. And through thick and thin, we've managed to keep 30 years of this journal going. This first panel is called The Financial Crisis: Causes, Dimensions, Consequences. And we have a panel of three. And we're going to begin with Brenda Spotton Visano. Sorry, Brenda. Visano, who is does economics at your office. Yeah, right? In public policy. Mm-hmm. So Brenda, we'll start with you.
Thank
right?
you. Thank you very much. Okay. Let's just see if we can get lights. Oh, yeah. Okay. I want to thank the organizers very much for the opportunity to come and meet with you, and particularly Jim Stanford, who extended the invitation himself. Just a bit more background. My area of research actually is from the economics, from the non-orthodox economic side in financial institutions. And just recently, in 2006, Routledge published my book on financial crises. Of course, the current situation is not in the book, but this talk will take a look at the current situation in the context of how I view financial crises, and specifically what I've called it is certain illusions, and the double entendre there is intended. Really, the message to be communicated is so perfectly, if incompletely, captured in this cartoon that appeared in the Economist magazine a little while ago, where it's "Capitalism is dead" is the new growth industry, right? And that illustrates the sort of what I think are a couple of important points, and it won't be a surprise to this audience that there are incredible contradictions in capitalism. But in my study of the last 300 years of crises throughout Western economy, financial systems, I would say that capitalism has got an incredible resilience. And what I want to illustrate today is that the contradictions, in fact, really lend themselves to that resilience in a multiplicity of ways. And then if I can get through all of that in enough time, I'll say a couple of words about where I think the quote-unquote solutions or resolutions lie. But first, just the context. This is how I'm viewing the current financial crisis, informed not only, of course, by the media, but also how I read financial crisis in the work that I do. First, the financial in the current crisis is, as we've seen, the insolvency of lending facilities and the suspension of credit. And so we saw the spike in bankruptcies of subprime mortgage lenders in August of 2007. The demise of Lehman Brothers, AIG, Fannie Mae, Freddie Mac, whatever, very recently, a year later. Okay? So we see financial crisis is defined as the collapse of lending institutions, and we may also see it, and we have seen it this time around, as a sudden drop in the price of financial marketed assets. And so here's a standard picture. The Dow Jones Industrial Average, the large stocks trading on the New York Stock Exchange, is now, or was recently, 53% of its peak value a year earlier. So that's what typically defines a financial crisis. But the argument, of course, is that the crisis in financial crisis is not financial. It is when that crisis in the lending markets, the lending institutions, and the financial markets spreads out to hit the people on the ground. The real crisis is in the rise in unemployment, drop in production trade, of course. And the piece that I'm really particularly concerned about is the regressive income redistribution that results. And this is such a hard piece to get your head around, sort of more precisely, but in the first instance, yeah, no, it's wrong. Okay. So the traditional story, give or take, trying to fit it onto the PowerPoint slide here. The traditional story, the accepted story, the widespread story, that the proximate cause of the current collapse is that the housing bubble bursts, forcing large-scale defaults on ninja mortgages, no income, no job. Oh my God, how could you take out a mortgage? How irresponsible of you. Collateralized debt obligations. These are a new financial instrument that come out of the financial markets and this innovation that we've seen in the last 5 years. The CDO market collapses and takes with it the mortgage lenders. The mortgage lenders collapse, the investment banks holding these particular financial instruments collapse. So, if your house is worth nothing, you're insolvent, everybody to whom you owe funds will also be insolvent. The network linkages through portfolio holdings of different financial instruments is causing this domino effect throughout the system. And related, what they call asset-backed securities, and in particular we'll see that the people taking out mortgages, that they play a critical role here in the traditional story. Commercial lending institutions suspend credit facilities, credit-constrained producers cut back production, they incur layoffs, and unemployment rises. That is your typical story. Give or take a line on a PowerPoint slide. Okay. So it tends to be the case that you get a lot of people, at least in the current analysis, and that's always tough, of course, the current analysis of the crisis, pointing to irresponsible borrowers and greedy lenders. And the point here is that the the causes of the financial crises are identified as individuals who have been irresponsible. All right? Adjustable rate mortgages. This is your rate, the rate of interest is going to fluctuate. And a lot of these mortgages, particularly in the U.S., came out with what they call teaser rates, so that it was a 2% mortgage rate, but in interest rate, but in 6 months it was going to increase to whatever the prime rate was. The adjustable rate mortgages with teaser interest rates seduced unqualified, and I put that in quotes here because this notion of being unqualified is contingent on the current situation. Okay, unqualified borrowers into the housing markets. Lenders repackaged the mortgage for sale, ignoring the default risk, ignoring the fact that these borrowers may not be able to pay back their mortgages, sent that risk out to someone else, and the then current situation bred a naive confidence. With no change in the existing situation, both the borrower and the lender situations would have been sustainable. All right? But the traditional explanation for the cause of this crisis is that the frontline borrowers, I mean the people taking out the mortgages, and the lenders, those mortgage brokers who were out on the ground forcing these people to take loans they couldn't afford, were ignoring systemic risks. That's the story. There's some elements of truth to it, but as the explanation for the financial crisis, I want to challenge it. I want to step back, put this in a broader context where we are looking at the economy and taking into account, in a very Keynesian, Minskian type way, the presence of fundamental uncertainty. Okay, so I want to put that piece aside about the contemporary explanations of the current crisis. I want to take up and bring in the notions of fundamental uncertainty and how they play out for Keynes and for a number of other sociologists and economists who take up this notion of how people act when we do not know, cannot know the future. Faced with fundamental uncertainty, we develop rules of behavior, customs, codes of conduct, i.e., quote-unquote, institutions, to create a certainty and to limit and bracket our uncertainty. Successful institutions create an environment that permits the current situation to be predicted into the future. We see that in a number of situations in our daily lives, where we are creating rules of behavior. Let's everybody pass on the right. Thank you very much. It creates a certainty about how we are going to be passing people on the street. It's very simple. It's a simple rule. If we all follow it, it actually does create a certainty. I will be sure to be able to pass on the right. And if you guys totally ignore that, we've got chaos. Protracted success feeds confidence. Now, in 20 minutes, it's going to be really difficult to sort of pull together all the layers in which I think this story is so important for what it is we've seen again in the history of finance capitalism. Let me try. Facing fundamental uncertainty, we adopt customs and codes of behavior, institutions writ large, that determine and bracket and create a certainty where that uncertainty, replace the uncertainty with a type of certainty. That happened, we saw, with the frontline borrowers, with the frontline lenders. And you know where I'm going to go, is that we also see it with the government, and we also see it with corporations. But here I'm arguing that we also see it with economic and financial theorizing. That the orthodox theories of financial markets, the efficient markets hypothesis and all the rest, created a particular framework for analyzing a particular type of marginal risk. Everything else constant, I want to try and deal with this credit risk if only this instrument collapses in value. That actually marginalized the whole problem of systemic risk. So you've got a whole industry out there that are focused on high-level mathematical techniques that are trying to give quantitative measures to a type of risk that's not inconsequential. It is. It's important. But in ignoring the systemic and interdependent risks that are present in the stock market and all the other asset markets, that ignorance created an instability, the result of which we see today. Protracted success. I mean, this efficient markets hypothesis, it's been the mantra of mainstream economists and orthodox finance theorists, and the sort of on-the-ground industry interpretation of it for about 30 years. The protracted success, part economic and part social. I'm working in the financial industry, and we all believe that markets are efficient, and you believe that markets are efficient, and so we feel a whole lot better because we both know we're right. Right? That's the social piece that's coming on. But a confidence in the framework. The result, financial deregulation and what they've called disintermediation, where instead of going to the bank, you go into the markets and issue bonds yourself, are the result. It's taking a long-term view. The contradictions. Here are a couple. Belief in the individual is paramount in the efficient markets hypothesis and in the way in which economists and finance folks are taking up their view. And the belief in the individual is paramount because I believe it, because Erin believes it, and so I feel confident that we are right, because the prevailing opinion shared by so many was and is the belief that that's right. Belief that financial markets are unfettered by regulation generates or yield prices that best reflect the true economic resource allocation stories, values because we collectively ignore the importance of group psychology and collective action. Ignorance and greed on the front line as the cause of the current crisis is not untrue. Because the large banks and the mortgage institutions ignored systemic risks and jumped on the financial profit bandwagon. At a higher level of abstraction, institutions of finance capitalism, and this is the essence of the book, of what I'm writing about in the book, institutions of finance capitalism provide the means to encourage the speculation, innovation, and accumulation that define capitalism. But these same institutions, the way we operate with them, contain the seeds of crisis. Leveraging of investment in speculative ventures increases and spreads the longer the success of the venture. This is a very Minsky type story. But I'm applying it not to just the actual financial speculator, but to the economist believing in efficient markets, to the finance person who's taken that notion that financial markets should remain unregulated and gone to lobby the governments and the central bank. Okay? And that whole unfolding, that evolution, increases the fragility of the system. The ultimate contradiction, is it that the institutions of finance capitalism created to reduce uncertainty and promote stability create the means of speculating that has supported willful ignorance of available information, reintroducing uncertainty and the threat of instability. Institutions of finance capitalism thus reduce uncertainty by creating the illusion of certainty. And what we have seen is that that illusion of certainty that has prevailed in the financial markets for the better part of 30 years just got busted. But capitalism is resilient, and that's why I love that cartoon. The culture of individualism is pervasive. We see it in the explanations of why we've got the crisis. Explanations are themselves idiosyncratic and to the particular configuration of institutions. All we need to do is prevent a housing bubble, and that's it. We will have cured financial crises for all time. And that is what they have done after every major financial crisis in the Western world, as well as in the 1998 spate of financial crises in Southeast Asia, Brazil, and Russia. They all came up with very country-specific, institution-specific reasons for why they had a financial crisis, plugged those holes with regulation, and were convinced that they had solved the problem. Preventative financial regulation designed to prevent financial crises have, by and large, historically targeted the idiosyncratic proximate causes of the existing, the current financial crisis. The resiliency comes in, that the profit motive is strong, the culture of individualism is pervasive, and the financial participants with the profits that are there, the potential profits that are there, generate such innovation and creativity as we've seen anywhere. The solutions? Preventative financial regulation, or financial regulation designed to prevent the current crisis will appear, will appear as, should the central bank target asset prices and therefore prevent a housing bubble? If we prevented the housing bubble in the US, we would have prevented the mortgage excesses. Had prevented the mortgage excesses, we would have prevented all of the cascade of crises that followed from it. Okay? I think we will see those sorts of results. I don't personally think that they will be very effective. I think that we will also see a rebuilding of the containment regulations, the ones that are going to increase the margin rates on hedge funds and things that are going to try and prevent and contain the existing crisis if it appears. So try and keep it to just one market, try and prevent it from spreading to other markets. I think that's the most likely outcome of this current crisis, and I think it's more promising than the regulation designed to prevent a housing bubble. Okay? But if we accept that this is a systemic crisis, then we need systemic or system-based, system-wide, system-based solutions. Where my work is going, where I believe that our best chances of strengthening the economy lie in addressing the income distribution piece. To challenge individualism, to promote community responsibility, and to reduce the vulnerabilities of society's most disadvantaged requires building and rebuilding local communities. But that's not, I know one might hear it as a protectionist argument. It's not, it might have those implications, but it is not intended in the first instance to be a protectionist argument. It is in order to get people to recognize that they are not in a world where what they do is independent of what everyone else does. They have to know their community, their fellow community members. And you can't do that in a global financial network. To challenge the hegemony of neoliberal foundations of the contemporary economic and financial theory, efficient markets, what have you, I fear a little that we're going to see a wholesale replacement of sort of the extreme conservatism that is buried in the financial theories of efficient markets and what have you, with a more Keynesian type, right? A Keynesian type theory. My view of what is to be preferred, because we do not know, or we wouldn't be here, we do not know what the answer is for now and every time going forward, is not to have one dominant theory, but to encourage the diversity of perspectives in the way we think about the economy, in the way we think about, particularly, the financial markets. And if I were really technically sophisticated, I'd call back up that cartoon as a way of ending the talk. I hope I'm able to make a little bit of sense out of it. I look forward to hearing the rest of you. And okay, thank you very much for the lovely introduction. And thank you so much for listening.
Thanks very much, Brenda. We're now going to have Erin Weir, who's an economist with the Steelworkers.
Okay, well, thanks for jumping in as chair. I'm kind of jumping in as a presenter. Jim Stanford couldn't make it today, so I'm here in his stead. Glad to be here. It's a real privilege. The title of this session as a whole involves causes, dimensions, and consequences, so I'm going to try to address all three of those things from a labor perspective. In terms of causes, I guess I would just make the point that the economy's reliance upon consumer borrowing and the housing bubble in particular really is a result of the lack of real wage gains that we've seen in Western countries in the past decade or longer. I'm sure people are familiar with the recent Statistics Canada census results, which showed that median earnings for full-time workers in Canada hadn't increased at all in real terms in the past 25 years. So what that means, in effect, is that there wasn't enough increase in purchasing power of consumers to keep up with the increases that were taking place in productive capacity. Now this lack of aggregate demand was aggravated by what was going on in other sectors of the economy. So the government sector for years now has been bringing in more in revenue than it's been putting out in terms of spending and public investment. The corporate sector also has been bringing in more through profits and depreciation than it's been investing back into the economy. So what you have is, households with not enough income, to keep pace with production in terms of consumer demand. You have the government drawing more out of the economy than it's putting back in, and you also have the corporate sector doing the same thing, drawing out more than it's putting back in. So the only real sources of growth in the Canadian economy for years now have been, first of all, consumer spending financed by borrowing, and in particular borrowing related to the ownership of real estate, the value of which until recently was increasing. Ultimately, of course, that all proved to be unsustainable. And then the second source of growth in the Canadian economy was trade, was the fact that the country was exporting more than it was importing due to high commodity prices. And that in turn has proved to be fairly unreliable. So that's a little kind of synopsis of the causes of the current economic crisis, just in terms of the main sectors of the economy: households, governments, corporations, and trade. In terms of the dimensions of the crisis, I guess the question here is, how bad is it really? And I guess I would just draw people's attention to the gross domestic product figures released by Statistics Canada this morning for the month of November 2008. And what they showed was a decline in real gross domestic product of 0.7% in that month. And that's really quite a dramatically large shrinkage of the economy in 1 month. It's the largest decline we've seen since the power outage in August 2003. And if we exclude that fairly unique event, it's really the largest monthly decline that we've seen ever since February 1997, which is the oldest month in which we have precisely comparable figures on this. So quite a dramatic shrinkage of the economy. And I guess what it means is that from November 2007 through November 2008, the Canadian economy declined by 0.8%. Obviously, almost all of that decline happened just in the final month. But that's in fairly stark contrast to most of the mainstream private sector forecasts embodied, for example, in the federal budget earlier this week, that assumed that although we are definitely headed into a recession in 2009, that real gross domestic product was going to grow a bit in 2008. Since we've now seen real gross domestic product actually decline, from the end of 2007 until near the end of 2008, I think that's now in doubt. And I think this morning's numbers suggest, if anything, that the situation is worse than most people thought it was. I guess another question is, how long is the crisis, or how long is the recession at any rate going to last? I would say there's probably two dominant views of this. The kind of Bank of Canada view is that real GDP will keep declining until about the middle of 2009, and then we'll turn around just in a few months from now and start growing again. The other view, I guess, embodied say in the Canadian Centre for Policy Alternatives alternative federal budget, is that we'll have real GDP declining in 2009, 2010, and then maybe recover after that. I think it's frankly really hard to predict what's actually going to happen with that. And from a labor perspective, it almost doesn't matter which scenario plays out, because even after real gross domestic product turns around, there's a very high likelihood that we'll experience a prolonged period of relatively high unemployment. So in other words, even if the economy, as measured by real GDP, turns around pretty soon, the labor market is going to be bad for a long time. And that's exactly what we saw in recent Canadian recessions. In both the early 80s and the early 90s, there's only 1 year each time where real gross domestic product actually decreased rather than increasing. But after that, there were several years where unemployment stayed high or actually increased. And the reason for that is that as the economy starts to recover, initially businesses can increase their output by getting existing employees to work more hours or by exploiting improvements in productivity. So it takes a while to kind of exhaust those avenues and get back to a point where businesses actually have to hire more employees in order to get more output. The other dimension in all of this, of course, is that Canada's population is growing, so you don't just need some economic growth to reduce unemployment. You actually need more economic growth than population growth and productivity in order to reduce unemployment. So almost no matter what happens with the official measure of recessions, it seems to me we're headed for an extended period of fairly high unemployment, and I think that argues for public policies aimed at creating jobs and providing adequate benefits to the unemployed. And I think that case is compelling, even if you accept the Bank of Canada view that the economy, as measured by real GDP, is going to turn around a few months from now. So the third thing I'd like to talk about is the consequences of the crisis. And I guess the consequences probably fall into two categories. The first, maybe you might call it kind of subjectively, is that what's happened to the economy really validates a lot of what the labor movement has been saying about the economy for several years now. It really does give credence to the concerns about real wages not increasing in line with productivity, or really not increasing at all, according to Statistics Canada. It really validates all the concerns about the out-of-control financial sector, which has become increasingly disconnected from the real economy. It validates the concerns about Canada being almost completely reliant on the export of raw commodities. And so it creates some opportunities for the labor movement to put forward a bit of a different political agenda. And I won't talk too much about that because I think that's really the train of the following session. What I'd like to move on to, though, is the more kind of objective, practical consequences of the crisis for unions. Because although there are these opportunities for unions to take advantage of now, unions are obviously losing a lot of members because of what's going on in the labor market. As a consequence of that, unions are losing the dues that those members would normally pay, and so unions actually have a lot less capacity than they did before, to respond to the crisis and to take advantage of some of these possibilities that might be out there. So in terms of what's happening to unions, I guess I think it's important to distinguish between different sectors of the economy. I mean, there's some sectors, such as forestry, that have really been in horrendous shape for years and years, and it's not entirely clear that the current economic crisis, is really changing anything for them. The auto industry, not too far behind, it's been losing a lot of workers and really in crisis for at least a couple of years now. On the other hand, you have sectors such as basic steel and mining and energy that really were booming until literally just a few months ago. So the impact of the economic crisis depends on which sector you're talking about, whether you're talking about sectors that were already in pretty severe crisis, or whether you're talking about sectors that were booming until all of this played out very recently. Another sort of difference to take into account that has different implications for different unions is their dues structure. If you're a union that has dues that are a fixed number of dollars per month, or sort of 1 hour's wages every month, or something like that, you obviously lose dues if members lose their jobs, but as long as members hang on to their jobs, you still do get the dues coming in, even if the economy is in worse shape. On the other hand, if you're a union whose dues are structured as a percentage of earnings, then of course you do lose dues if your members lose their jobs, but you also lose dues if your members just lose overtime hours, or lose bonuses, or lose any other form of their earnings. So I guess I would just kind of conclude on the point that the union I work for, the United Steelworkers, has been hit pretty hard and pretty suddenly by this crisis, because a lot of our membership is in sectors such as steel, as the name suggests, but also mining, which were really doing quite well until just a few months ago. And also our dues are based on a percentage of our members' earnings. So in addition to losing dues from people who lost their jobs, we're getting lower dues from people who might still be working but aren't getting overtime or aren't getting bonuses, etc. So I think I'll just kind of wrap it up there, having talked about the three items for this session. But I really look forward to having a bit of a discussion, and I look forward to the next session as well. So thanks very much for your time.
Thanks, Erin. So our last speaker in this session is Katharine Rankin, who's in geography here at UNT. Thanks, Katharine.
Thank you, Rosemary. Well, for something really quite different, I am not an expert on the financial crisis, and I'm not an economist. I'm an anthropologist turned geographer planner, and I've been working for the past few years on microfinance as a sort of paradigmatic market-led strategy for international development. This is a topic I've become really sick of, but I thought this panel was maybe an occasion, well, I should say the topic has become somewhat more interesting in the context of the financial crisis, right? And that this panel would be an occasion for me to kind of curiously explore the relationship. So I'm subjecting you to that. And I also thought it would be a good occasion to sort of think about how critical development studies could be brought to bear on the financial crisis, maybe rather abstractly for some of you economists. So there are just 3 points I want to make. And one, which I'm going to spend the most time talking about, is to explore the paradox that multilateral and other donors seeking to promote this market-led model of development continue to quite forcefully advocate making loans to poor women in small villages all over the third world as a safe investment, right? Even as the financial crisis, as Brenda has shown us, is commonly blamed on the subprime loans to poor people who are not able to pay off their debt in the urban centers of the global north. So I thought this was an interesting paradox to look at, and many of you are probably familiar with the attempts over the last year to attribute the risky subprime lending in the U.S. to the Community Reinvestment Act, right? That was the legislation passed in the 1970s in the wake of activism surrounding the redlining scandals in American cities. And CRA required banks to lend throughout the areas in which they collect deposits, including in poor neighborhoods. And it's enforced at the moment when a bank applies for a merger and their activity in this kind of lending is made public. So the claim on the political right is that the CRA caused banks to undertake loans in demographic sectors and geographic areas that they would have deemed too risky, right, under normal market conditions. So here are some examples of headlines in right-wing papers late last year. The New York Post, The Real Scandal, How the Feds Invented the Mortgage Mess. The National Review, People Losing Their Homes Are Victims of Government-Sponsored Political Correctness. So, I mean, even if this kind of extreme version has been discredited, I think it's fair to say that one popular understanding of the crisis, as Brenda has argued, is or rather, one popular interpretation continues to be that it is caused by subprime loans to poor people. And I think it's interesting to explore how this kind of popular wisdom can be compared to the popular wisdom underlying microfinance, which is built on this proposition, right, that lending to the poor is both financially lucrative and financially sustainable. And the claim here, of course, is that very small loans to mostly women can spawn their kind of latent entrepreneurial capacity and kickstart rural economies. That if borrowers are required to invest in productive activities, then market rates of interest can be charged, and that the risks of lenders can be devolved onto the borrowers, right? And through ridiculous kind of disciplining mechanisms that you probably know all about. So I did a bit of web searching around microfinance and the financial crisis, and all over the web you see that the World Bank and its affiliates are kind of scrambling to portray microfinance as above the fray or outside the reach of the current crisis. So they cite evidence that financial services for the poor have historically shown resilience to shock. So looking at the Asian financial crisis, the microfinance institutions barely blinked while corporate portfolios collapsed. Indonesia especially held out as an example where you had the currency collapsing, the economy in decline, the impoverishment of the middle class, but microfinance institutions held their collective loan portfolios. And some of the explanations for how this could have happened, probably not surprisingly to you, go like this. That microfinance institutions lend in closed ecosystems and subsistence-based economies that are not likely to be affected by global financial events, or even that some microenterprises might benefit from crises because they're providing these basic services more cheaply than other providers in the formal sector. That microfinance is not leveraged. It has a concrete source, right, in people's savings, and it is dispersed through face-to-face intermediation, based on trust and old-fashioned relationships. So, even if there's some acknowledgement that this time around high food prices and fuel shortages and so forth are likely to have some impact, the prevailing message is still that, with proper management, lending to the poor is still a good development strategy. So, for example, of some headlines, microfinance still hums despite global financial crisis. That's Time magazine in December, in which Nobel laureate Muhammad Yunus says the financial crisis has not hit the microfinance system. In the middle of all this bad news, microfinance still works. Bill Clinton urging investors to consider the poor of developing nations a viable investment alternative to today's turbulent markets. And then all along, donors continuing to advocate, more, not less, market-based lending to the poor. So how to account for this paradox? Well, of course, one way is to conclude that lending to the poor is not the cause of the crisis, and the liberal version is pretty obvious. Structured properly, lending to the poor can be profitable. The more radical version that Brenda started to get into has to do with looking at how subprime loans feeding off the bubble and the housing crisis were a trigger, right, not a cause of the crisis, that the crisis has more systemic origins, and there's a great article in the New Left Review this month, I think, by Peter Gowan, who identifies this systemic origin as the new Wall Street system, right, developed over the last 25 years. In innovating in the kind of speculative arbitrage that crucially creates bubbles in the real economy rather than responding to them, and in the formulation of the kind of shadow banking system that Brenda also described. Okay, but I think more importantly, the two paradoxical assertions that I was looking at point to what both this market-led system in development and the Wall Street system actually have in common. And that is that a progressive vision about the public purpose of the credit system has, in both contexts, been given over to a view of banking strictly as a mechanism for the self-expansion of money capital, right? So for the Wall Street system, that is obvious enough, especially probably more so to many of you than it is to me. But I thought I'd think about that in relation to microfinance, that it represents a transition from thinking of finance as sort of a public purpose with redistributive aims to a mechanism for self-expansion and money capital. And here it has to be remembered that this model of development represents a shift away from the now kind of much maligned development finance of the 60s and 70s, which grew out of a Keynesian principles, right, that involve the disbursement of agricultural credit through state banking systems at subsidized rates of interest. And these systems were cast as financial repression, right, in the 1980s, and microfinance was the neoliberal remedy, right, that was brought in to free up poverty lending from non-market considerations and state failure. And since then, the sector has moved more and more in a kind of commercialized direction aimed at generating profits for lenders rather than providing services to social citizens with rights to credit. And you probably know this story. It's about, the sort of growing diversification of services in the microfinance sector, so they're starting to provide insurance and deposits and ATM services and so forth. And also, crucially, that prudential regulation at a national scale is being imposed on debtor countries now as one of the key forms of structural, of conditionalities in multilateral lending. Lots of examples here. But the upshot is that this sector is starting to look a lot more like mainstream commercial banking. Also, that, subprime lending and microfinance have plenty of on-the-ground practices in common, like pushing credit on borrowers to ensure debt-fed growth. And the examples of, Citibank's billion-dollar campaign to get homeowners to take out second mortgages so that they can, live richly, reminded me really of the loan officers of microfinance programs riding around their bicycles in villages in rural Vietnam and Nepal where I work, trumping up new borrowers for microfinance. So a real push on the poor to borrow money. And also, in both systems, the Wall Street system and this model of development, there's this kind of creepy coherence between those who are financing financial services and those who are regulating them. Now, of course, in development, that's kind of politically opposed as opposed to politically chosen. But nonetheless, in both cases, it's a sign of this very well integrated project. So the point, again, is that microfinance as a market-led development strategy is not somehow kind of outside of the financial crisis. It's part of the same ideological apparatus and regime of accumulation. So that was point one, and I want to just, for point two, I'll be much briefer, and make a comment about what is happening on the ground with market-led finance in the development context. And I'm referring here to work I've done in Vietnam and Nepal, read a lot about other contexts. Bolivia is fascinating, fun to talk about. But anyway, what's happening on the ground? First of all, I just want to make 2 points about this. One is that it depends on where, obviously. And I would say that in places like Nepal, where class disparities have arisen from very long legacies of internal colonization and donor dependency, inadequate investment in human development, microfinance is not doing a whole hell of a lot, right, for spawning rival businesses. People are taking advantage of this source of credit, of course, but are finding ways to use it to spend on basic household needs, like food and health. And I'll talk in a minute about how that's sustained financially. But in places like Vietnam, and which is really quite interesting, and I want to talk about in my third point, microfinance really does seem to be helping people undertake new or kind of deepen their involvement in entrepreneurial activity. But and this is obvious, but access to credit alone is not the only explanation. And if you read accounts of microfinance in these kinds of settings, that is the only explanation given. More significant is the prior investment by the state in health, in education, in public infrastructure that establishes a basic, and crucially in land reform, land redistribution, that establishes relative equality of opportunity, that supports people in their livelihoods, whether it's in microenterprise or whatever else they're doing. So what people do with this kind of resource on the ground depends on a host of political, economic, and cultural political factors that, of course, fall outside the scope of financial programs to control. And the other point I'd make about what's happening on the ground is that people always find ways to subvert the rigid market prescriptions of programs like this, right? So that, and the point here is that conceptions of productivity that are embedded in market-led models deny any kind of social basis for economic livelihood, and people resist such conceptions because their livelihood depends on it. So they invest microfinance everywhere, not just in income-generating enterprises, but also in what goes in the business as consumption, on things like weddings and funerals and other social investments that are necessary to maintain their status in place-based networks of obligation. And they do this by repaying debt with debt from other sources, which is increasingly possible with all these microfinance programs running around. And so here's another parallel between to the financial crisis, which is that in certain development kind of hot spots where there are these multiple sources of credit, the entire system is growing increasingly unstable as the oversupply of credit enables borrowers to endlessly finance consumption with debt. So then to the third point, which has to do with alternatives and kind of segues to the next section. I wanted to dwell for a minute on the experience of microfinance in the context of Vietnam, which is pretty fascinating. It's a long story, but the interesting thing to note is that the banking sector is one sector in Vietnam that the party state has been hesitant to relinquish control of, since banks are still involved in the management of state enterprises. So state-owned banks have always been viewed as mechanisms for reducing poverty and targeting economic development to disadvantaged sectors and regions. So you find state-owned banks with branches across the countryside, providing credit at subsidized rates, disaggregated, by geographic, where they want to target loans geographically and to which economic sector. So when the donors brought in microfinance with the economic liberalizations in the 1980s, they attempted, as they do in many places, to use this model as a mechanism for introducing market criteria in poverty lending. And what was interesting to see was how the Vietnamese party state systematically contained and managed the donors so that microfinance was limited to very small pockets of donor-funded programming, and that this was implemented through the Vietnam Women's Union, which is one of the party state's key kind of organizing arms in civil society. So all of this served to actually strengthen the local state rather than develop this kind of this alternative autonomous market system that the donors had hoped. And this is something that Jim Delaney, who just walked in, has also written about. So, so even in the context of these donor-funded programs, interest rates were kept low, loans were dispersed on the basis of need, and so forth. And most of the time, this all worked because, first of all, the basic social supports that made it possible for even the poor to undertake business ventures, but also because local cadres and women's union leaders and various other sources of funds from the state could usually be relied on to help people out who had repayment difficulties. So very different model of credit distribution. So what thoughts then arise from all this in relation to the financial crisis. I think analytically, thinking about how land distribution and investments in health and education and infrastructure had those kind of equalizing effects does encourage us to think about the subprime crisis as having its roots in places different from what the common stories are, and that those roots have to be traced, and there's Leo and Sam have written about this, to the failure of the U.S. state precisely to provide this kind of massive public expenditure on affordable housing, right? And secondly, that practically, I think the Vietnam case, however much it may actually be changing quite rapidly right now, actually, is kind of an inspiration to think ambitiously about alternative models now in the current conjuncture. And one obvious point would be to argue that demanding that public expenditures on services and infrastructures to meet basic human needs, rather than financial markets, should be the basis of integrating poor people into economic activities. And this requires thinking about the poor, of course, as social citizens with rights to credit. And banks not just as profit maximizers, but as underutilized institutions to be activated for a kind of affirmative redistribution of wealth. And so it would also kind of shift the focus from thinking about more prudential regulation in the current context, but to a more kind of more transformative understanding of what has to be done now, having to do with, I mean, certainly I've really glossed over some of the Vietnamese context, and the key piece of that transformative orientation to the finance sector would have to be thinking about how to democratize the economy. So I think these are probably issues that we'll get into the next section, and I'll stop here and look forward to the discussion.